Hello there, ExxonMobil employees. Welcome and thank you so much for being here. I'm Sam and I'll be moderating this presentation. In just a minute, we're going to be joined by Tyson Mavar, one of our ExxonMobil focused senior advisors here. And Tyson is going to be covering ExxonMobil's healthcare options in retirement with you. And after his presentation, if we have time, he will also answer a couple questions. I encourage you to pop open that Q&A box. It's completely anonymous. And if you have a question while he's speaking, feel free to ask away. We will always try to answer as many as we can. What he does not answer live with you, we will have another ExxonMobil focused advisor answer through email or phone after the presentation has ended. Throughout the presentation, I will be entering some links into the chat. These will guide you to various places on our webpage. There will be a ExxonMobil focused retirement guide, as well as a link to book an appointment with one of our advisors and the complimentary cash flow analysis that you can get started on that Tyson will go more into depth with you about throughout his presentation. And very quickly, before Tyson gets started, I want to just remind you that we are not affiliated nor endorsed whatsoever by ExxonMobil. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. And without further ado, let's jump right into it with Tyson Mavar.
Thank you, Sam. Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mavar. I'm one of the ExxonMobil focused retirement advisors for the retirement group. And today we're going to talk about something we haven't really covered much recently, but there has been some recent changes to the ExxonMobil retiree health benefit options. We're going to talk about some of the important considerations, some of the cost issues, some of the timing issues on retirement, and hopefully give you some value related to your decisions on retiring with ExxonMobil, choosing health insurance benefits, and hopefully helping you have your money last longer as a result of making good decisions with your money and your benefits. So we hear from constantly our clients from ExxonMobil, and when we ask about what is your biggest concern as you approach retirement, typically it's running out of money, right? But what has people thinking they're going to run out of money most commonly has to do with healthcare costs and just not understanding how health insurance works. For you, maybe you have a spouse, maybe you have kids involved. Health insurance is going to be a big cost for almost every retiree relative to the total costs of retirement. There's probably lots of things that you like to do and want to do with your retirement. Health insurance costs are typically not one of the things we enjoy spending money on, but maybe one of the most important expenses that we have as we get into retirement. So let's talk about how that works at ExxonMobil. We have three segments to today's webinar series: the cost segment, the alternatives prior to age 65, those of you who leave ExxonMobil before you turn 65, and some of the other issues related to Medicare and benefits in general when it comes to health insurance. Interestingly enough, when we talk to people, first of all, most people don't realize what benefits ExxonMobil offers for health insurance. And far too often we find that when building their retirement plan, and honestly, most people don't even have a plan until it gets way too close to retirement. Just something we encourage you to take advantage of, our complimentary retirement cash flow analysis. So you can start to identify what are some of the costs of your retirement going to be, and do I have enough money? When's a good time to retire as a result of wanting to build a sustainable plan? But statistically, the average American believes that they will only spend about $41,000 on healthcare costs in retirement. In actuality, that is a $274,000 shortfall on what the real costs incurred by the average retiree are related to their healthcare. So we find that the average couple age 65 will spend about $315,000 on healthcare throughout their retirement. Now, if you leave ExxonMobil prior to age 65, which I find in my experience with clients is more common than folks waiting to 65 to retire, in part because you gain retiree status at age 55 as long as you have 15 years of service. And I also have some people leave and go work somewhere else or come back as a consultant or do some contract work. A lot of people leave before age 65, so that means the costs are going to be higher than $315,000 on average. Fortunately, there are some good benefits that will reduce your total costs that ExxonMobil has decided to subsidize for retirees as long as you get that retiree status, 55 years old with at least 15 years of service. And these costs, by the way, are a 5% increase above what they were last year. So they're climbing at a higher rate than normal inflation for a normal basket of goods and services in the United States, which has been the case for maybe forever, for a long time at least, which is certainly something we want to pay attention to, the rising cost of healthcare and retirement. We saw that drug prices increased 5.4% over last year, with 983 pharmaceutical drugs that are commonly taken by retirees increasing. And what we found is it's very helpful for retirees or folks that leave ExxonMobil once they've reached retiree status, 55 with 15 years of service, to have these benefit options even before you turn 65 and qualify for Medicare. So currently, if you are already retired or are retiring this year, the pre-65 retiree medical benefits are offered through Aetna. Now, I have just received some documentation related to changes that are happening next year, where the company will be changing for all pre-65 retirees. The retiree health insurance plan will be changing from Aetna to Blue Cross Blue Shield starting January 1. We don't know exactly what that's going to mean. Presumably, at least according to the letters sent out by ExxonMobil, this is to be more efficient. Now, it's likely either going to save money for ExxonMobil or save money for the retirees. Hopefully a little bit of both, or at least for retirees. But it still remains to be seen what that is going to mean to everybody affected, everybody who is retired from ExxonMobil, qualified for medical benefits, but is not yet 65 and qualified for Medicare benefits. Now, some other options you may have if you don't reach retiree status. Of course, if your spouse has a health plan, definitely want to consider that. Even if you did reach retiree status, it might be worth shopping the plans to see whose is going to be either the best plan or the most cost-effective plan. If in fact your spouse is still working or has a retiree plan that might be a little bit better. Certainly if you go back to work after ExxonMobil, if your new employer has a health plan, that would be worth shopping and comparing costs with as well. And there are the state exchanges. The Affordable Care Act has an option for people with no insurance that may want to save some money. And there's also some ways that you can qualify for lower premiums as a result of maybe not having too high of an income. And so, all sorts of benefits for those that didn't reach 55 and 15, or maybe you just wanted some different options. Affordable Care Act, they're going to have some decent options for people, but it's not going to be the best option for a lot of people. And where I hear the most gripes is people just having administrative issues dealing with government health insurance. This is not a big deal for everybody. If you can find a cheaper plan, that might be well worth your time to see what type of benefits and how they could fit into your and your family's healthcare needs, because everybody's are different. Everybody has different prescription drugs they need, different health concerns. But this is a decent backup plan for those that don't have this ExxonMobil retiree option, or if you didn't hit the 55 and 15-year milestone. Best advice I can give, and probably the biggest takeaway from this, is that it's imperative to run a cash flow analysis before you leave ExxonMobil. This is something we'll do for you for free if you work for ExxonMobil, even if you're not a client, because we know that, or at least are very confident, you're going to get a lot of value out of this, to where, number one, you may consider doing some business with us, hiring us as your financial advisory team for retirement after you leave ExxonMobil. Or at the very least, even if you don't work with us in retirement, you're likely going to have a good enough experience to recommend our services to some of your coworkers, which is very valuable to us. And what you'll get out of this is uncovering future problems before they exist so we can fix them ahead of time, determining what the cost of healthcare is going to be and how you're going to finance it, what's going to be the most tax efficient way to finance that. And then tax efficiency strategies in general, things like net unrealized appreciation, something you may want to consider utilizing with your low cost ExxonMobil stock that you have in your Voya plan. Things like Roth conversions, when to do them, how much makes sense, planning for required minimum distributions, which is a very big deal in many people's case, and even some estate planning strategies that can allow more of your money to go to your kids, your spouse, your grandchildren, causes that are important to you, and not get eaten up by taxes, ideally. Now, for those of you that retire and age into Medicare eligibility at 65, or maybe you waited till 65 to retire, ExxonMobil still subsidizes your health insurance through this MPO plan, this Medicare primary option. And even if you didn't reach retiree status, you didn't work until 55 and 15, this is going to open up a lot of doors for you, even though you won't get the ExxonMobil subsidy. So lower premiums, better benefits in many cases, and a guarantee that 80% of your expenses will be paid by Medicare. The enrollment period is very important for Medicare is up to 3 months before the month you turn 65 and up to 3 months after the month you turn 65. So about a 7-month period. And you definitely want to take advantage of this, because if you don't sign up for Medicare, it's possible you can have penalties on your Part B premiums after you eventually do sign up for Medicare, even if you didn't need Medicare at the point you were turning 65. So make sure that you're at least signing up for Medicare. And then for those of you that have not signed up for Medicare, you're going to need to do this anyway if you're already 65 when retiring from ExxonMobil. If you want to take advantage of the ExxonMobil Medicare Advantage option that is also offered through Aetna, as it turns out, to reduce your premiums. Not everybody believes in the benefits of the Medicare Advantage plan. There are pros and cons that we'll go over in a little bit, but it's certainly worth considering given that ExxonMobil has offered to subsidize this. And I will say that more than half, a majority of my clients that are retired and over 65 are on this Medicare Advantage plan offered through ExxonMobil in conjunction with Medicare, or the Social Security Administration. So let's go over those advantages and disadvantages of the Medicare supplement, also known as Medigap. This is traditional Medicare with a Medicare supplement plan, or Medicare Advantage, also known as Part C, which is the option that's now available through ExxonMobil. They changed this a few years ago because they used to have a Medicare supplement. Now it's just the Medicare Advantage plan, or Part C, which is all inclusive, all encompassing portions of Medicare in one plan. So with Medigap plan or Medicare supplement plan, you keep traditional Medicare, choose your own doctors, a big benefit for many. You are going to have higher premiums, but no copays. Average costs typically $90 to $200 a month. No referrals necessary, also a big benefit for some. There's some routine services that are not covered specifically with vision and hearing, but you are covered anywhere in the US, which is a very big benefit for many. And it's guaranteed renewable, and benefits will never change. So a lot of good benefits to a Medicare supplement plan, but you would give up the subsidy that's coming from ExxonMobil if you did not go onto the Medicare Advantage plan. Medicare Advantage plan, biggest benefits, it's going to be cheaper. But let's go through some of these. You're going to forfeit original Medicare, and you're restricted to in-network doctors, which is a big disadvantage for a lot of people that I've talked to. Lower premiums, but you will have copays, which will increase your total costs. $0 to $100 a month, depending on the plan. And you may need a referral for specialists, which is another disadvantage of these quote unquote advantage plans. There may be some additional benefits, vision, hearing, fitness, to name a few. And there are emergency services, only emergency services are offered outside your coverage area, and the benefits can change year to year. So this is the breakdown on pros and cons. Just remember that ExxonMobil is only going to subsidize the Medicare Advantage or Part C option if you go through the MPO option, as they call it, the Medicare primary option offered from ExxonMobil. Now, for higher income earners, almost nobody realizes until they get to age 65, there is something called IRMA, Income Related Medicare Adjustment Amount. It's a premium you pay on top of your normal premiums, depending on what your income was 2 years prior to the year that you are considering. So for example, here we are in 2024. They're going to look back to your income from your tax return in 2022 to see what your income was. And if it was above a certain threshold, you're going to pay premiums, and it's graded so that there's actually, I believe, 5 brackets we'll see here in a moment. The more money you make, the higher your Medicare premiums go, both for Part B and for Part D, as it turns out. And so we have an example here. I'm going to zoom into Bob and Jane momentarily. So this is what we call a split family. Bob is already eligible for Medicare. He's over 65. Jane is not yet. Bob has total cost of $304.60 a month. Part A, which is a free portion of Medicare, as long as you worked enough quarters and paid into it. Part B for Bob, he was in the lowest bracket, so it was $170.10 a month for Part B. His Medicare supplement was $127 a month and $7.50 a month for the drug plan, or Part D. Jane's health insurance premiums were actually $1,200 a month, and she had this silver PPO plan through Blue Cross Blue Shield. Hers is going to be quite a bit more expensive until she turns 65 and can go on to Medicare. Now, I will tell you, it's likely going to be cheaper for a family, an ExxonMobil retiree family who qualified for both the plans, the post 65 and pre 65 retiree medical insurance options through ExxonMobil. But that's $1,500 a month for this particular family. And although it's going to go down when Jane turns 65, that adds up. It is going to be a decent part of many families' budget. So here's that, we zoom into the IRMA brackets, the premiums. I was wrong. There's actually 6 brackets. So you can see the lowest one is $174.70. That was Bob's bracket. So presumably him and Jane, married filing jointly, their income was lower than $206 per year, modified adjusted gross income, and that was looking at 2022. So his income could be higher this year, but it wouldn't count until 2 years out when they're looking at 2024. You can see it's going up. It goes up about $70 a month into the next bracket, then over $100 a month into the next bracket, then another $100 a month or more, the next bracket. So it gets more and more expensive to the top earners, paying $594 per month. And this is per person, remember, even if you're filing a joint tax return. So the highest bracket could be over $1,000 a month. And this is just looking at Part B premiums, which is, by the way, the most expensive part of Medicare, but gets pretty expensive. And this is something we are aware of. We'll often recommend our clients do Roth conversions toward the end of the year, where we're moving some of their pre-tax dollars that were either in their 401k or lump sum pension when they were at ExxonMobil, and probably now in an individual retirement account, either at Schwab or Fidelity, which is where we manage money here at the retirement group. Oftentimes we'll recommend Roth conversions, but we have to be careful, not only looking at the ordinary income tax brackets, but also these IRMA tax brackets, and try to justify the best possible Roth conversion strategy without kicking somebody into too high of an IRMA bracket and making their premiums for Medicare more expensive in future years. So very important to keep in mind. We also saw premiums going up a lot more in some areas. You know, we talked about earlier, 4% increase on average from last year to this year. But look at some of these states. Oregon went up 17%, Massachusetts 16%, Alaska 15%, Maine was 15%, South Carolina 15% increases on healthcare costs to people that live in those states. So varies state to state, and maybe some states are smaller increases, but these are vastly growing portions of retirees' budget as healthcare costs continue to go up at rates faster than every other budget item in a retiree's expense list. Now, Medicare Part A, we talked about the premiums being free on that. I'm going to zoom in here. You can see, though, that there are additional costs, such as inpatient hospital deductible, $1,600 up to $1,632 in 2024. Co-insurance from days 61 through 90 for hospital stays, up to $408. Hospital co-insurance lifetime reserve days up to $816, and skilled nursing facility daily co-insurance from days 21 to 100 up to $204. These costs aren't going down, folks, so we have to prepare for them. Now, to wrap up today's, we're going to have a couple questions here to go through if we have time that Sam will let us know. But best takeaway from today, get a cash flow analysis done. There's a lot of different firms available to help you with your retirement asset management, tax and distribution strategy, and benefits options and decisions after you leave ExxonMobil. We think we're a pretty good one. Give us an opportunity to do some work for you for free by running that cash flow analysis. I'm very confident it won't be a bad investment of your time. Worst case scenario, you verify everything you're doing perfectly. Best case scenario, we poke some holes in your plan. You go back to the drawing board. Maybe you didn't do business with us. You give us some referrals as a thank you for the help. And maybe you do some business with us if you like our approach, and you get along with one of our representatives, myself being one of them, and many representatives around the country. We'd love to have a conversation and get to know you a little bit better. Also, we'll publish these webinars that we do on our LinkedIn page, and there's a QR code on this slide that'll take you there if you have interest in going through that. Interesting study before we get into the questions. Vanguard did a study like this a few years back, very similar results. This is a Russell study. It says, what's the value of a financial advisor? If you're paying close to 1% a year of your assets under management for help, what are you getting from that? What Russell determined through this was that behavioral coaching, which is essentially just verifying your decisions, being a sounding board for your ideas, whether it's investment purchases, decisions on when to retire, buying and selling different assets, tax strategies. Behavioral coaching, they said, was worth over 2% per year when they looked at what somebody who had an advisor versus somebody who didn't have an advisor, how that added up over time. Comprehensive portfolio construction, I thought that would be worth more, but they said only 0.62% per year. And active wealth management was worth over 2%. So I would say that also makes sense. So if we can help you preserve and grow your net worth better than you could do on your own, by more than what our cost is, then it was an obvious decision to work with a financial advisor. But most people don't know what the value add is going to be until they actually do a test run of services. We encourage people to open a small account with us before you retire, see if it's a good fit. If not, no hard feelings. If so, I'm very confident it will be a easier, smoother, less stressful transition into retirement. Now that you know you've got a team looking out for you that is very qualified in doing their own job. If you want to schedule a meeting, you can take a picture of this QR code, call us at the home office at 800-900-5867, or email us at info@theretirementgroup.com. Any questions you have, or just to get in touch with one of our advisors around the country. So with that said, if we had any questions, we have a couple more minutes. We can take any that came up.
Thanks, Tyson. We have maybe 2 minutes. Are you good to?
Yes.
Okay, great. We're just going to do one, and the other questions we will get to through email or phone with you guys. And just as a reminder, all of the things that Tyson has just mentioned, there are also links to in the chat. So utilize that chat, take advantage of those. The complementary cash flow analysis link is in there as well. All right, Tyson, one question. If I retire before reaching 65, how can I minimize my healthcare expenses until I qualify for Medicare?
Yeah, great question, by the way. Big factor is whether or not you reach 55 with 15 years of service and are eligible as a retiree for health insurance benefits. So if you did not, you're going to have some tough decisions to make. And like we talked about some of those options, if you're not married or you don't have a spouse that has an option and don't have a job opportunity, most people that are leaving before age 55 are probably going to have to keep working. So I would say find a job that has a reasonable employee health benefit program. And then the biggest fallback is Affordable Care Act through your state exchange. And we can talk you through how to apply for benefits through that, which is also income-based in terms of how much of a subsidy you're going to get from the government. But best advice I have, make it to that milestone of 55 years old with 15 years of service before leaving ExxonMobil. It's going to reduce your costs substantially. It's going to allow for your beneficiaries, your spouse, as well as children, to stay on a plan in case they don't have options. And then you're also going to get a subsidy once you turn 65. So a lot of huge benefits from reaching that milestone, 55 plus 15, in addition to just what you gain on your pension plan.
Got it. Alrighty. That was it, Tyson. We are out of time today. Thank you so much for all of your time and all of your knowledge and experience. Thank you, everyone, for joining us. We really hope to see you on another webinar very soon. Have a nice day.
Thank you, folks. We'll talk to you soon.
Thanks, Tyson.